Okay, let's talk about Walmart. We're talking about the ultimate retail fortress here, an absolute giant of industry. This is a company currently boasting record revenue, booming e-commerce numbers, and it holds that highly coveted status of a dividend king. It's basically a cornerstone of the American economy, and let's be real, countless retirement portfolios. But if you take even a quick look at the recent charts, something really jarring is happening. We are looking at a brutal 17% stock drop, plummeting from its recent highs of $135 all the way down to $112. That is a massive haircut for a company usually known for its unshakable stability. So, that leads us to the multi-billion-dollar question. Why is this retail fortress falling? When a blue-chip behemoth like Walmart takes a sudden dive, it creates a serious dilemma for investors. Is this 17% drop a rare, golden opportunity to scoop up shares of a world-class business on sale? Or is it actually a dangerous value trap signaling deeper underlying issues that just haven't fully surfaced yet? Today, in this explainer, we're going to unpack exactly what is going on beneath the surface of that $112 price tag. All right, let's dive right into this. First, we'll weigh the bull case against the bear case, then we'll map out the technical roadmap, and finally wrap up with a future outlook and strategy. Starting with Section 1, the bull case and the growth engine. Because honestly, underneath that falling share price, the core, fundamental business is actually rock solid. The sheer scale of the fundamental data here is just staggering. Take a look at these Q1 numbers. Walmart posted $177.75 billion in revenue. That's a 7.4% jump year over year, which handily beat Wall Street's expectations. On top of that, their earnings per share topped estimates too, coming in at 66 to 67 cents. But the real story here, the metric that has analysts literally buzzing, is e-commerce. Online sales surged a massive 26% year over year. This completely shatters the old narrative. This isn't your grandfather's brick-and-mortar Walmart anymore. They are aggressively, and I mean successfully, competing head-to-head with Amazon in the digital space. And how exactly are they pulling this off? Well, they're rapidly evolving from a traditional low-margin retailer into a diversified tech and retail powerhouse. A prime example is their recent acquisition of the ad platform vbuy.co. This is a total game changer. It supercharges their high-margin advertising business, seamlessly integrating it with their growing AI-assisted shopping experiences. Think about it. They aren't just selling groceries anymore. They're selling a highly targeted advertising space to the exact brands that stock their shelves, which brings in incredibly lucrative margins. This technological transformation is exactly why Wall Street loves this transition, and it's a huge reason why an overwhelming 43 analysts still maintain a firm buy rating on the stock, despite the recent drop. Moving on to Section 2, the bear case, valuation and insider activity. Because if the fundamentals are so outstanding, we really have to ask why the stock is getting hammered. The danger lies right in the valuation. Walmart's current forward PE sits at roughly 37, while its 5-year average is only 27. So at a 37 multiple, you are paying a massive premium for absolute perfection. Investors have basically already priced in all of that amazing e-commerce and advertising growth. The real danger here is that if the broader economy slows down, or if Walmart's growth decelerates even a fraction of a percent, that high multiple is going to contract, and it will contract incredibly fast. The stock simply has zero room for error at these levels. And that brings us to a major red flag that is seriously spooking retail investors. $400 million. That is the exact value of the shares sold by the Walton Family Holdings Trust this past March. And they didn't sell at the current $112 level. Oh no, they sold right at the absolute peak of $135. Plus, it's not just the family trust. The company's CEO has also been actively trimming their own personal holdings. Now, sure, there are always arguments to be made. Some analysts will tell you this is just routine leadership transition planning or standard portfolio diversification. But let's be realistic here. When the family that literally built the company from the ground up decides to offload nearly $500 million worth of stock at the very top of the market, it fundamentally changes the risk-reward equation for the rest of us. When you combine a sky-high valuation that's priced for perfection with company insiders sprinting for the exits, it paints a very clear picture of why this stock lost 17% of its value. The setup today is just way less attractive than it was a year ago. Let's look at Section 3, the technical roadmap and the ABC correction. We need to shift from the fundamental why to the objective technical where the price is going next. So coming off the lows of late 2023, we saw a textbook five-wave impulse rally that took the stock to its 135 peak, basically the euphoria phase. But since then, we've entered a classic ABC corrective pattern. Wave A was that initial sharp drop that took the wind out of the sails and brought the price down to roughly $113. Right now, sitting around $112, we are essentially in Wave B. This is a temporary bounce where the price is testing overhead resistance right around the 60-day moving average near 117. So what comes next? According to technical models, we're waiting on a Wave C decline. Technicians fully expect this final downward leg to wash out the weak hands, likely taking the price down to retest heavy support levels near $105, or potentially even as low as $100. That zone is what we call the expected panic low, and historically, that's where these types of corrections finally end. Now, because we are in that Wave B phase, we have to beware of the classic dead cat bounce. You know the one. It's that temporary, short-lived recovery from a decline that completely traps buyers right before the downtrend resumes. The charts are telling us that the recent stabilization around $112 to $117 is likely just that. So I want to caution everyone here. From a purely technical standpoint, the overall trend remains heavily bearish until the stock can convincingly break out and close above that $117 resistance level. Until that happens, gravity is just pulling this stock toward $105. Which brings us to Section 4, Future, Outlook, and Strategy. Let's form a concrete game plan for the next 12 months. This timeline lays out the critical milestones perfectly. Right now, at day 0, the absolute smartest technical play is patience, waiting to see if that Wave C panic low actually materializes. But the most important fundamental catalyst on the horizon is right in the middle, August 20th. That is when the Q2 earnings report drops, and the entire market is going to be laser-focused on two specific things. First up, consumer health. Are shoppers continuing to spend freely, or are they trading down to cheaper alternatives because of inflation? Second, margin guidance. Remember that massive 26% e-commerce growth we talked about? Well, the market wants to know if those heavy investments in digital infrastructure and delivery are starting to eat away at overall profitability. The answers we get on August 20th will absolutely dictate the trajectory for the next 12 months. But here's the wild part. Despite the short-term technical gloom, Wall Street remains incredibly bullish. Just look at the massive gap here. With the current price at $112, the consensus target sits at $138, which implies a very healthy 23% upside. And if you look at Goldman Sachs, they are even more optimistic, planting their flag at a $154 price target, suggesting a potential 37% gain. It creates this really fascinating dynamic. You've got highly optimistic 12-month fundamental targets contrasted directly with a smart money technical strategy that says, hey, wait for the 105 panic low before you buy. Because think about it, if you can grab shares at $105, those upside percentages become even more explosive. So distilling all of this analysis into our key takeaways for this explainer, it really comes down to these three pillars. First, the growth is outstanding. Their e-commerce and high-margin advertising arms are firing on all cylinders, proving they can absolutely innovate. Second, the valuation is undeniably expensive. At a 37 PE, you are paying a premium and betting that this incredible growth not only continues, but accelerates. And third, the technicals are firmly in a corrective ABC pattern. The charts are flashing a big warning sign that a better entry point might be just around the corner. Look, Walmart is a legendary business, for sure. But as we've seen, even an unshakable retail fortress needs to take a breather every now and then. Which leaves us with the ultimate question for your own portfolio strategy. Based on this incredible growth potential, weighed against the current high valuation and a bearish chart pattern, are you jumping in and buying right now at $112, or are you staying patient and waiting for that 105 panic low? Take these insights, check the charts, and figure out the strategy that works best for you. Thanks for joining me on this explainer, and keep learning.